On December 9th, 2025, a report was published that should have stopped the heart of every single investor in the world. It wasn't about a war. It wasn't about a pandemic. It was about something far more dangerous. A silent betrayal inside the financial system, one that directly affects anyone who owns cash, stocks, or a pension. JP Morgan Chase, the same bank that spent decades suppressing silver prices, the institution fined nearly $1 billion for rigging the metals market, just flipped. They didn't just change their opinion. They made a move so large, so aggressive, and so final that it signals the end of a 40-year financial game. And they did it quietly, before anyone was supposed to notice. Because they saw a mathematical trap snapping shut, and when this trap closes, the price of silver doesn't rise. It reprices violently. 750 million ounces. That is 750 million ounces of physical, deliverable silver pulled out of the market. That is $22 billion deployed by the smart money at all-time high prices. Why? Why would the ultimate insider, the bank that profits from shorting the little guy, suddenly bet the house on silver skyrocketing? Because they looked at a set of data that most people are ignoring. They saw a mathematical trap snapping shut, a trap involving a London freeze, a geological crisis in the mines of Peru and Mexico, and a technological demand shock that cannot be stopped. They know that the silver market is effectively dead, and the only thing left is the violent repricing. By the end of this video, you are going to understand the 3 specific dates in early 2026 where this mathematical impossibility hits the breaking point. You will see why the wolf has suddenly decided to join the sheep, and why this isn't a safety signal, it's a warning siren. But to understand why they flipped now, you have to understand the secret they've been hiding in the vaults since October. And that story starts with a silence that was louder than any scream. Let's put this 750 million ounce number into perspective, because human brains aren't wired to comprehend that scale. That is nearly equivalent to 1 full year of global mine production. Imagine if Saudi Arabia bought every single barrel of oil produced on Earth for a year and buried it in the desert. That is what JP Morgan just did to the silver market. For decades, traders whispered about the JP Morgan short. Every time silver tried to rally to $30, to $40, massive paper sell orders would materialize on the COMEX, crushing the price and sending retail investors panic selling. It was clockwork. It was the widowmaker trade. You simply did not bet against the bank. But something broke this year. In October 2025, silver lease rates, the cost banks pay to borrow physical metal from each other, spiked to 35%. In a healthy market, that rate is usually around 0.25%. When banks are willing to pay 35% annualized interest just to hold a metal bar for a few months, it means one thing: panic. It means the metal isn't there. This brings us to the first domino. On October 8th, a buyer, rumored to be a sovereign entity, likely India, placed an order for 1,000 tons of silver on the London market. 1,000 tons. In the grand scheme of things, that's only 4% of annual production. It's a large order, sure, but the London Bullion Market Association, LBMA, claims to hold nearly 1 billion ounces in its vaults. This order should have been a non-event, a blip. Instead, the market ceased. Liquidity vanished. Major Swiss refiners like Metaller announced they were suspending trading until January 2026. Think about that. If you go to a bank that claims to have $1 million in the vault, and you ask to withdraw $40,000, and they lock the doors and turn off the lights, what does that tell you? It tells you the money isn't there. If this feels uncomfortable, that's the point. These are the moments the media never walks you through in real time. If you want to understand what's breaking before it becomes headline news, make sure you're subscribed. Once this story finishes unfolding, there won't be a rewind button. Does this sound familiar? We saw this in 2008 with mortgage-backed securities. Everyone claimed the assets were AAA rated and liquid until someone actually tried to sell them. The London freeze of October 8th was the moment the curtain fell. The LBMA vaults are empty of free-floating metal. The silver they claim to have is likely leased, released, and encumbered by ETFs. JP Morgan saw this. They realized the fractional reserve game was over. They didn't flip their position because they had a change of heart. They flipped because they realized the paper market was about to collide with a physical wall. But here is where the story gets darker. Most people think JP Morgan is just front-running a standard bull market. They aren't. They are positioning for a geological event that no amount of money can fix. To understand why a bank with $3.9 trillion in assets would panic buy physical metal, you have to understand a fundamental flaw in how silver is produced. This is the dirty secret of the mining industry, and it's why supply cannot respond to price. In 2024, global industrial demand hit 680 million ounces. In 2025, it's even higher. We have been in a structural supply deficit for 5 consecutive years, drawing down roughly 820 million ounces of above-ground stockpiles since 2021. That is an entire year of production simply vanished from the vaults. Now, a rational economist would say, well, prices are at all-time highs, around $64. Surely, miners will just open more silver mines and increase supply. This is where the trap lies. And to explain it, I'm going to use the bakery analogy. Imagine a bakery that sells bread. The baker makes his profit on the bread. But, as a quirky bonus, every loaf of bread comes with a small, free cookie. The baker doesn't bake cookies separately. They are just a byproduct of the bread dough. Now, imagine suddenly everyone wants cookies. The price of cookies skyrockets. People are waving cash, begging for cookies. Can the baker make more cookies? No, because he only gets a cookie when he bakes a loaf of bread. Unless people buy more bread, there are no more cookies. Silver is the cookie. About 70% to 80% of the world's silver comes as a byproduct of mining copper, lead, zinc, and gold. Miners are digging for copper to build the grid. They are digging for zinc to galvanize steel. Silver just happens to be in the dirt with them. If the global economy slows down and demand for copper or zinc falls, miners dig less dirt. And if they dig less dirt, silver production falls, even if silver is trading at $100 or $200 an ounce. We have seen this pattern before. In past recessions, when base metal demand drops, silver supply tightens exactly when investors want it most. It is the ultimate inelastic supply curve. JP Morgan knows that Mexico, the world's largest producer, saw production grow by only 2% last year. Peru is down. Chile is down. Or grades, the amount of silver found in each ton of rock, are plummeting. We are digging deeper and finding less. So you have this smart money, looking at a market where the vaults are empty, the London freeze, and the mines literally cannot ramp up production, the byproduct problem. But that's only half the equation. The other half, the demand side, is what terrified them enough to deploy $22 billion. Because a new monster has entered the room, and it eats silver for breakfast. For years, we talked about silver as money. We talked about coins, bars, and jewelry. But the market has shifted beneath our feet. Silver has quietly transformed into a strategic energy metal, and the consumption numbers are staggering. Let's look at the 3 heads of this new beast. First, solar. In 2024, solar panels consumed nearly 200 million ounces. That's 25% of all mining supply. China alone installed over 250 gigawatts of solar in 2025. And here is the kicker. Despite the high price of silver, solar manufacturers aren't using less. They are using more because newer, high-efficiency technologies like Topcon and HJT cells require more silver per panel, not less. This demand is policy-driven. It is government-mandated. It doesn't stop because the price goes up. Second, electric vehicles. An EV uses up to 50 grams of silver, almost double what a gas car uses. With EV production growing 13% annually, this sector is locking away millions of ounces that will never be recycled in our lifetime. But the third head of the beast is the one nobody saw coming until it was too late: artificial intelligence in data centers. The AI revolution is a hardware revolution. It requires massive server farms, 5G towers, and complex circuitry. You cannot have high-speed data transmission without silver. It is the most conductive metal on the periodic table. There is no substitute. If you want a future with AI, you need silver. JP Morgan's analysts ran the numbers. They saw 1.2 billion ounces of industrial demand crashing into a mining sector that can only produce 835 million ounces. That is a mathematical gap that cannot be closed. Does this sound familiar? We saw a similar dynamic in palladium a few years ago when emissions standards tightened. The price went parabolic because the auto industry had to buy it at any price. The factories cannot stop. If you are Samsung or Tesla or a Chinese solar manufacturer and you need silver to finish your product, You don't care if it costs $60 or $120. The cost of the silver is a fraction of the final product's price, but without it, the product is zero. This is called inelastic demand. So let's recap. 1. Inelastic supply. Mines can't produce more because silver is a byproduct. 2. Inelastic demand. Industry can't buy less because there are no substitutes. 3. Empty vaults. The London market broke when someone asked for just 4% of the supply. This is the perfect storm. This is why JP Morgan stopped shorting. They realized that if they stayed short, they would be annihilated by the physical reality. But they didn't just go long. They did something much more aggressive. They are cornering the market in a way that makes the 1980 Hunt brothers look like amateurs. And the crucial difference between 1980 and 2025 is the reason why this time the government won't stop them. You cannot talk about silver without talking about the Hunt brothers. In 1980, two Texas billionaires tried to corner the silver market. They drove the price from $6 to $50. But they failed. Why? Because they used leverage. They bought on margin. They borrowed money to buy paper contracts. When the Federal Reserve and the exchanges changed the rules, raising margin requirements and restricting credit, the Hunts were forced to sell. They were crushed by debt. JP Morgan knows this history better than anyone. That is why their strategy today is fundamentally different. JP Morgan is not using margin. They are using their own balance sheet. They are paying cash. They are taking physical delivery. They have 750 million ounces of real metal sitting in real vaults. There is no margin call on metal you own outright. There is no silver Rule 7 that can force a bank to sell its private property. Unless the government invokes the Defense Production Act and literally seizes the metal, which would destroy the U.S. financial reputation, JP Morgan is untouchable. We've seen this pattern before in history. The golden rule, he who has the gold or silver makes the rules. The bank has moved from playing the paper game, which is vulnerable to regulation, to playing the asset game, which is protected by property rights. They have effectively removed 750 million ounces from the market. That supply is gone. It is in a black hole. Now, think about the signal this sends to the rest of the world. The BRICS nations, China, Russia, India, they are all watching. They know the dollar is weaponized. They know treasuries are losing value. And now they see the premier American bank dumping paper to hoard hard assets. This brings us to the most terrifying part of the script, the endgame. The price targets JP Morgan is likely looking at aren't just high. They are historic. When we adjust the 1980 high of $50 for real inflation, using the metrics from the 1980s, not the watered-down CPI of today, silver should be trading at $600 an ounce. Current price? Around $64. JP Morgan deployed $22 billion at these levels. If silver goes to $200, a conservative estimate given the deficit, their position becomes worth $150 billion. That is a $128 billion profit. But to get that profit, the market has to break. And according to the timeline of events lining up for early 2026, the break is scheduled, programmed, and inevitable. We are staring down the barrel of 3 specific dates in January 2026. This is where the loops we opened at the start of this video close, and the reality hits. Date number 1, the Chinese export ban. New regulations from Beijing take effect in January, giving the CCP explicit authority to restrict silver exports for national security. China exported 660 tons in September 2025 alone. If they turn off that tap to feed their own solar and military needs, the global market loses a massive chunk of supply overnight. Date number 2, the metaller return. Remember the Swiss refiner that quit the market in October? They are scheduled to resume trading in January. The market is holding its breath. If they come back and say, we still can't source 1,000-ounce bars, panic will move from the institutional level to the retail level. Date number 3, the JP Morgan lease expiration. Reports suggest JP Morgan leased 4,000 tons of silver from ICBC, China's biggest bank, to plug the hole during the October freeze. That lease comes due in January. JP Morgan has to either return that metal that doesn't exist in the free market, or default on a Chinese bank. Any one of these events could trigger a price explosion. All 3 are happening in the same month. This sounds familiar because it's the exact setup we saw before the nickel squeeze of 2022, where the price doubled in hours. But this is silver. This isn't just an industrial metal. It's a monetary metal. It's the people's money. So, here is the reality you need to accept. The game has changed. For 40 years, the game was suppression. The big banks made money by keeping the price down and fleecing retail investors who tried to bet long. That game is over. The mathematics of the deficit made suppression impossible. The new game is accumulation and revaluation. The banks have switched sides. JP Morgan is now the biggest silver bull on the planet. But they didn't tell you. They didn't issue a buy recommendation on CNBC. They quietly bought 750 million ounces while the media told you silver was too expensive at $60. When the wolf joins the sheep in the pasture, he isn't there to eat grass. He's there because he knows a forest fire is coming, and the pasture is the only safe ground left. The betrayal isn't that they manipulated the price down for years. We knew that. The betrayal is that they used that manipulation to buy your silver cheap, so they could sell it back to you at $300, $400, or $600 when the industrial shortage becomes headline news. The supply deficit is real. The mines are empty. The solar panels are hungry. And JP Morgan has the keys to the vault. The question isn't whether silver explodes from here. The question is whether you understand what JP Morgan just told the market with their $22 billion bet. Are you going to wait for the official announcement that the vaults are empty? Or are you going to look at the signal? 750 million ounces. 0 short contracts. The predator has turned. I'll be tracking the January delivery numbers the second they go public. You do not want to miss that update, because if the lease rates spike again, the game is officially over. Make sure you are subscribed. The greatest wealth transfer in history is happening in the silver market. And for the first time in history, the banks and the truth are on the same side.